Dear investors, we had shared our market thesis in the last edition. We had expected just about double-digit returns from the market, uh, building in some amount of valuation correction. We broadly stick to it in spite of the sharp market volatility. There were several points that we considered, quickly recounting that. While the economy is at a pre-COVID high, the economic survey speaks of it, the growth outlook continues to be good as well. The economic survey points to a 8 to 8.5% growth with normal assumptions like monsoons to be good, no further COVID-related disruptions, and an orderly taper in the West, and maybe oil back at closer to 70 kind of range. Now, the points that we considered and which continue are one on Capex. Government Capex continues. The budget focuses, that's the high point of the budget. It focuses really well on Capex. There's a large increase there to 7.5 lakh crores. Household Capex started. Housing sales are strong and buoyant and could stay that way given increases in incomes, increases in organized sector employment. And private sector capex has been continuously given a boost with one global macros like China Plus One and PLI schemes which the government itself has launched. Second, the wealth effect that we spoke about continues. People have made money over the last 2 years in all asset classes, and hence the confidence in the market stay high. At the same time, income effect is strong. IT sector, the largest employment generator, is looking at employing record numbers, not only for this year, but for the next 2 years as well. And hence we believe that any sharp drop like the one that we experienced in the month of January would be bought into. As we speak, there is a large part of that drop has been bought into. Third, earnings continue to be strong. COVID-related disruptions have been low. Q3 results are coming in broadly as per expectations. While Tata Motors is pulling numbers a bit on the lower side, the broader market, this is something that we are noticing, and maybe we'll talk about it more in the next session. Which was delivering numbers significantly in excess of core Nifty, is now delivering almost similar growth. So the breadth of the market could be a casualty, and we need to keep an eye there. Now, what is not happening is commodity prices. We had really expected commodity prices to drop as the supply chains normalized. However, because China has continued to adopt a zero tolerance policy towards COVID, the disruptions have continued. Commodity prices are staying high. While steel prices, oil prices are $90 versus 70, 75 a month or two back. This is really stroking inflation and inflationary expectation. At the same time, the strength in the US economy and the job generations there is again also providing up move in inflationary expectations. And versus 2 interest rate increases that were expected 3 months back, now the expectations are of 4 or even more rate increases in the US. Now we need to watch this space. If it dampens growth momentum in the US, it would not be nice for equities, but that would happen after the first few increases. First few increases typically have been digested quite well. Indian regulated rates should also be expected to increase over the next 1 year, but maybe lower than that of the US. The gap in our bond yields and that of the US is still substantial. Okay, the chart shows that given our good forex condition, we do expect RBI to be able to keep interest rates relatively stable, while the room is definitely reducing because of the large borrowing calendar that has been brought out in the budget itself. And that may cause some amount of stress there. Already bond yields in India have moved up. Maybe they can correct a bit down again, but from a 6.25, 6.3 level, they're now closer to 7. What may help during the year is inclusion in global bond indices. I guess some more changes need to be made there. Buying and selling, for example, of Indian bonds by global funds should be excluded from taxation. I think that is something which investors are looking for. In any case, I think the externals look reasonably okay, and a small depreciation would not be negative for the rupee. Higher oil prices, if they sustain beyond geopolitical normalization, the Ukraine stuff, etc., could hurt the economy, and we could see larger current account deficits for this fiscal in spite of strong IT exports. However, overall, it may be positive for profit aggregates as banks get to fund more, commodity companies deliver better profits, and these are the two large profit pools while IT continues on its path, and yes, may be helped by some amount of rupee depreciation. Banking system is distressed, and hence this oil shock can be much, much better withstood. In terms of users of commodities, they have been able to pass on substantial price increases, but the price increases have been lagging input increases, and we have witnessed margin pressures in the quarterly numbers, and this can continue. So what we have is the picture that we have is that the lower P businesses, banks, corporate banks, commodities, maybe even IT are delivering a higher percentage of growth in earnings, while higher P businesses could see a contraction because of margin pressures, and hence overall on the index valuation multiples could shrink. For better things for India, oil needs to come down to closer to 70, and that would be much, much more sustainable. We had noted that taper tantrums would be lower this time around versus last time. I think the space is now much better understood. And while every time there is expectation of a rate increase or a rate increase happens, currency markets move and it will result in volatility in the equity markets, but it would be volatility. Downtakes on account of such volatility should be a good entry points. Performance of the markets, I believe, would be determined more and more by our own policy initiatives and corporate and economic performance rather than what happens elsewhere. I think over the last few months that's been brought out quite clearly. Budget has been tabled. The run up to the budget, it was clear that there are sections in the economy where there is stress. Recovery has been K-shaped. For example, contact intensive services are yet to recover fully. Stresses there in urban poor and self-employed. Budget did focus on providing some support to contact intensive services like hospitality. However, there is not much increase in support extended at this time to weaker sections. I think the government has been conservative in budgetary maths, and it would give it room to spend to support the weaker sections in case the need arises over the next year. On each count, both for fiscal 22, where we believe numbers would surpass what the government has budgeted, and in fiscal 23, both because of base effect and because of economic buoyancy, numbers in terms of tax inflows could be significantly higher, and that will give the government some room for spending to support consumption to address the woes of the weaker section. Or otherwise, versus a 6.4% budgetary deficit projected, it could be substantially better. Growth in Capex, which has been the focus of the budget, and the economy would help stressed spaces. Our fiscal is in a better condition versus most large economies, and hence I think very nicely, very rightly, we have chosen a path of measured fiscal correction rather than a sharp fiscal correction. That said, total tax collections are only around 10% of GDP, and Capex is just about 2% of GDP. And any increase in taxation or any increase in budgetary allocation can't move the needle much. Budget has more impact from non-tax incentive it gives, import duty protections, tax incentives, rather than for increase or decrease in spending on any one end. Interest costs are rising. The bulk of government borrowing has moved up because of larger fiscal deficits over last few years. And on top of it, now interest rate would move up. This will cause in fiscal 23 and beyond interest payments to be higher than usual, and this will constrain the fiscal space. Also, in financial 22, the excise duties were higher than the start point of financial 23, and which means the excise duty collection this time around would be lower than last year. Lower meaning that the growth would be much lower versus what was seen in financial 22. This again is impacting the budgetary maths. While I continue to believe it is very conservative and we could see a lakh crore or more of extra net tax inflows, focus on Capex is very, very welcome. Last point on the budget, it has been an exercise in continuity. Many initiatives such as PLI were taken over the course of last year and they would continue. Make in India has been given a fillip with a large jump in defense percentage allocation from 51 to 68%. They had introduced what items would need to be sourced from India already a few months back. So this is a continued effort. Graded duty structures have been introduced in a few items. Tax cuts on some steel items have taken place, but it would impact Indian industry only marginally if current steel prices sustain. I would say here that, in the past, just like gold determined wealth of a nation, my sense is market cap does the same in the modern period. I believe the greatest strength of India is its people and their enterprise. And if that enterprise is valued higher, the overall wealth of the country would increase. With higher retail participation in equity markets, I think budgets over time will be more focused on this aspect. And equity markets would get their due focus from the budget. Let's come down to investing themes and valuations. With the budget now behind us, we continue to believe in the same investing themes. Maybe financials could do a tad better on account of the budget, but otherwise the investing themes continue to be the same. While at the present there is this big debate about value versus growth, I think India is a growth market, and over time growth-oriented styles will get back into flavor. In any case, if a high growth business with profits, does not see price performance for some time, very quickly it becomes a value business. In terms of themes, faster growing spaces, for example, beneficiaries of China Plus One, which is textiles, chemicals, and pharmaceuticals, could continue to do well. PLI beneficiaries in electronics, beneficiaries of move away from unorganized towards organized, such as jewelry, are expected to continue to find favor with investors. IT services have been a flavor. They are having a very strong time. They've increased, improved guidance. And along with them, online businesses are benefiting from the COVID period and could continue to do well. The drop in recent stock prices provide a good entry point to my mind. As far as financials are concerned, once the NSE and LIC issues are behind us and they have been absorbed by the market, I believe the stock prices would much better be reflective of the profit move. As of now, managers are having to make space for large issuances, and that may be keeping performance from happening in this space. With commodity space expected to weaken as supply disruptions reduce, consumption, branded consumption names, there have been increases prices in the past, but have not been able to pass on the price increases fully. As their input prices reduce, they should be able to do much better. So our portfolios continue to reflect a sizable presence in the consumption names. Cement should do well now that the rainy season is behind us and the Capex is becoming the focus once again. In terms of the market, one should expect the markets to consolidate as large IPOs are still around the corner, and they should be expected to suck out secondary market liquidity. In this period, strong earnings growth would provide support. Happily, COVID third wave seems to be receding and has caused lesser damage than feared. There were no severe lockdowns, and that helped. We have noted before that changes brought about by global central banks in liquidity and interest rate should be expected to cause volatility, which should be taken advantage of by investors, because ultimately valuations and earnings would provide the market direction. Our view on earnings remain the same. We expect earnings growth to be around 15 to 17% in 23 over 22, which means the last thing that we need to focus on is valuations. Valuations are higher than long period averages and may have sustained if earnings growth continued to come from similar spaces. However, the mix of earnings growth is changing, with more earnings coming from commodity spaces, corporate banks, maybe even IT, where valuations are typically lower than other spaces, and hence blended valuations on the index should be expected to correct. Also, bond yields are moving up, and the other favorite indicator that we look at, bond yield to earning yield, is also showing that, with earnings outlook staying similar to before, prices would need to adjust a bit to factor in rising bond yields. Bond yields have risen sharply, as we noted before, because of large budgetary borrowing calendars, and also nudged up because globally the yields are moving up. Valuations would hence have to drop to account for higher bond yields. I hence believe it would be rational to expect indices to deliver returns lesser than earnings growth over the next few years, and hence thereby see a valuation correction. While buying on dips should continue to be a great strategy, and the current dip should again prove to be one such opportunity. Focus has to be on the good quality part of the market and away from commodities. We continue to believe they will decline as supply chains normalize and geopolitics steadies. With easy money having been made after 2 great years in the market, I think it will be a great idea for investors to take the services of quality focused professional money manager. Thank you everybody, and happy investing.